Central Board of Direct Taxes has proposed a roadmap to do away with tax incentives. This is in line with the Finance Minister Arun Jaitley's budget proposal to cut the corporate tax rate to 25% from the current 30% in 3 years. Now let's tell the top 5 highlights of the proposal. Companies and individuals cannot avail exemptions that are linked to profits and investments. Not just that, even area-based exemptions will be done away with beginning from FY18. This means companies can no longer claim tax exemption for setting up business in special states and remote areas. At this juncture, we should point out that state-based incentives will continue to exist, as there are proposals in only to scrap benefit from the central government. So if you have somebody setting up a plant in Pantnagar, it's up to the state government to decide on those tax incentives. Number 2, it's sunset for the sunset clause. The benefit from the sunset clause will not be extended beyond 31st of March 2017 for special economic zones. And it's not just SEZs, even oil and exploration projects cannot claim incentives starting FY18. Number 3, and in a move that's going to have ramifications for all corporates, the CBDT is proposing to reduce the rate of accelerated depreciation to 60% instead of the current 100%. That brings me to point number 4, tax exemption for research and development, that's R&D, has been halved to 100% from the current limit of 200%. The auto industry has already expressed disappointment over this move, and I suspect the pharma sector is going to be the next. Finally, no tax benefits will be provided to donations that are made to NGOs. Before we go any further, here's the Minister of State for Finance, Jayant Sinha, reiterating the need for India to have a simpler corporate tax regime.
The most important thing, of course, is that we want to make sure that it is revenue neutral and that our fiscal deficit targets are not touched. So we absolutely have to take that into account. That is going to be our objective function and as we think through the roadmap. So our goal is to be able to simplify and streamline the exemptions on the one hand, and then obviously on the other hand bring down the tax rate as well. Obviously the goal is to make this revenue neutral so that we don't suffer in terms of our revenue collection, but ultimately we think that this is going to really help businesses because they'll have a much simpler tax code.
So that's Jayant Sinha also reiterating that as the exemptions go out, we have to ensure that it is all revenue neutral. Now let's put all of this in perspective for you again. In FY15, the centre estimated to have lost 62,400 crore rupees on the back of corporate tax breaks. That's higher than FY14, and this fiscal they are projected to lose another 62,000 crore rupees. So this move that was announced today is aimed at recouping all of those losses. Remember, the Finance Minister has already indicated that even though India's corporate tax rate is 30%, when you take these incentives into account, the effective rate is just 23%. So with that in mind, what's the impact of this on India Inc. and the economy at large? To discuss that a lot more, we now join Manish Desai, partner at Deloitte India, as well as Gokul Chaudhri, the leader of Direct Tax at BMR Associates. Thanks, gentlemen, for joining us here tonight in India Business Hour. Gokul, I'm going to come to you first. We were discussing this earlier in the evening as well when the draft proposal was put out. I want to get your reaction on the fact that only 1 year has been given to corporates as of now to commence their operations, to enjoy a lot of the tax breaks and to enjoy a lot of the tax breaks where we don't have a final date for the sunset clause.
Well, Nantara, I do understand the point that you're making that the sunset clause has come right at 2017. The finance minister, when he spoke about the roadmap, we expected that there will be a staggered basis by which the various sunset clauses would be introduced for various provisions, and that will take into account the industries that are involved, the projects that are involved, and so forth. And therefore, even the staggering of the rate cut, which is expected, will happen over this 4-year period. Now, the finance minister has, at the discussion paper, put only one date, which is the 31st of March 2017. You begin your projects by then, you get your benefit, you're grandfathered on your tax holiday for the remaining period, and so forth. Well, is he going to reconsider that? Is he going to be allowing certain asset-heavy, capital-intensive projects to have a longer lead time before they get the sunset clause and before they get grandfathered? Well, that I think will be an outcome from the discussion paper, but at the moment he's pronounced a unilateral date of 31st March 2017.
Come in here, Manish. So there is only 1 year, you can say, for everybody to prepare themselves to enjoy the tax breaks that had been announced earlier. What I really wanted to get a sense from you was on SEZs, Manish. Do you think that SEZs are now a done story?
I guess the consultative paper which has been issued by the Finance Ministry today seems to suggest that the tax benefits which are associated with entrepreneurs developing SEZs and also people who are doing the business in the SEZs would have a sunset clause starting April 17, and that would definitely, if this proposals were to go on, would end. But I would also like to add there that we had tax holiday benefits associated very similar to SEZs, which were with STPR units, which a lot of companies, especially in the information technology sector, enjoyed. And that also had a sunset clause, and it has not been extended for a few years now. But we have still seen that the IT industry setting up and expanding their business base in India. So to an extent, the removal of the sunset clause for either the SEZ entrepreneurs or the people doing the business, I think is a dampener, but based on past experience of the removal of the sunset clauses for the STPR units, which has seen the industry grow, should not be in the longer term a dampener because of the benefits India as a country offers.
Okay, so you don't think the death knell has been sounded for SEZs. Gokul, I would like you to come at this juncture with what has been put out today. How are those exemptions going to pan out, assuming an SEZ commences before 31st of March 2017? I'm talking about the 5 plus 5 plus 5. And also this entire equation, are we reading too much into it? Because there's also the MAT levy that is there, which has removed some of the profitability in any case.
You're very right, Antara. We already have a MAT which completely dilutes the tax holiday and its impact. It gives the government an effective 20% tax collection on the profits, and MAT is intended to stay. So I think the government is very clear that while the tax holidays stand grandfathered by 31st March of 2017, they will effectively roll forward for their useful life. So therefore, in the context of SEZs, you get your 5 years plus 5 years plus 5 years, which effectively means that the tail end of the effect of the tax holidays could go all the way to 2030. And the Finance Ministry is very clear that they want to keep MAT in place for that period of time. So yes, what we will see is the fact that while the effective tax rate should come down during this 4-year period that has been promised by the Finance Minister, and I think the industry will be very happy if in line with the lowering of the tax rate, we also have the GST coming in, which will allow far more efficient supply chain for most industries, for most manufacturing, for oil and gas and power and so forth. Now, if we are able to get a very efficient GST plus a moderate tax rate coming in, plus allowing the existing projects which are going to go on stream by 31st March 2017 to have their full run of the tax holiday, I think corporate India should be okay with this basket of changes and reforms that are being proposed.
They're going to be okay, Gokul, with the basket of changes that have to do with depreciation, with the reduced rate now on exemption from 100% to 60%. And I'm not even going to begin the R&D discussion. I'm going to bring that in later on, what it's going to mean for the auto and the pharma sector. But quickly, how is the change in exemption for depreciation going to pan out? What's going to be the impact of that?
Okay, as far as depreciation is concerned, there is a list of assets which enjoyed an accelerated depreciation of 100%. Some had 80, some had 60. There was also an additional depreciation of 20% which was allowed to new plant and machinery that was being brought in and installed into manufacturing concerns. Now, in this discussion paper, they've only spoken about those set of eligible assets which had depreciation of 100% coming down to 60%. Now, let's not forget that in the previous budgets also, the list of assets eligible for 100% had been pruned down. It had been far reduced to 80%. So I would imagine that the number of assets that are being impacted is far fewer than what was originally there in the list, firstly. Secondly, the additional depreciation of 20%, which is there in the rule book, is not proposed in this discussion paper to be removed. So really the additional 20% depreciation in the first year is something which is currently proposed to be kept in place. And insofar as the capex is concerned, which was sought to be rewarded by way of an investment allowance of 20%, well, insofar as the investment allowance is concerned, that anyway had a start date and a cut-off date. And I don't think the Finance Ministry is tampering with that incentive because it has a certain shelf life.
Manish, this is Ronaja from the Delhi studio. We've been speaking to many of the auto companies, and many of them are really worried, especially as far as the R&D provision is concerned, given the fact that now the benefits will be halved to 100% from earlier tax reduction of 200%. And many are saying that this has come at a really wrong time, given the fact that many auto majors are looking to position India as an export hub. So they're really worried about that. I mean, how legitimate are their concerns? Because while, the R&D benefits may have been reduced, but the fact is, the larger, the goal, of course, is to bring down the corporate tax rate to 25%. So how legitimate are the concerns that the auto majors and the auto industry is raising?
I think in a country like India, where, developing technology, having more scientific research and moving up the value chain in technology is, very important. For companies which are in the auto sector, technology sector, pharmaceuticals. And if we are able to invest as a country in developing technology, that would definitely help as a country for doing our exports in all these fields. And therefore, it's very important for Indian corporates to continuously make investments in these kind of projects of research and development, scientific research, which would help them move up the value chain and therefore compete and in the global markets. And in that perspective, the government reducing the incentives on research and development and scientific research projects from various categories of a peak of 200% now to 100%, is a kind of a dampener for Indian corporates, because that would kind of reduce their abilities of getting tax incentives to do these kind of R&D projects. So I would believe the government should reconsider these kind of incentives to be at the current level and not reduce them. This would really be a positive signal if it is reinstated to its current position and help corporate India to be much more effective in developing more technology.
Manish, because this was something that I think stunned everybody on why the exemption on R&D must be removed so fast, with no window, literally from 200% to 100%, and by a government that is talking about Make in India. How do you make in India without R&D or exemptions for R&D? Gentlemen, we're completely out of time, so we're going to thank both of you for taking the time out and coming to our studios and help us decode that draft proposal on phasing out corporate tax exemptions. We would like to remind our viewers this is all at a draft stage.